Roll right in.
So welcome to Roll Right In Money, brought to you by Tim and Max from Oceanic, a San Francisco-based VC firm, along with me, Fabian, from StudioAlpha, a accelerator for software startups. Hi, Max. Hi, Tim. How are you guys?
Good to see you
Doing
again.
well.
Still summer in San Francisco, isn't it?
It's actually day two of the most beautiful days we've had maybe ever. It's just spectacular here.
Cool.
Sometimes October is our summer here.
Yeah,
It's an interesting microclimate.
Are you guys still surfing? Yeah, of course. You're surfing
Of course.
all year.
This is the season right now. In fact, it starts in October.
Yeah, I saw it online. So the Half Moon Bay, it was they had the last week, I think they were the first Mavericks for this season, like the first,
Yeah. We've had some pretty strange weather. So it went from really hot to really cold to raining. We got some snow up in Tahoe a week or so ago, and now it's back to 70 degrees and sunny. I read a report yesterday about the temperature rise and how high it has to get for there to be really true catastrophic events that are happening fairly consistently. And we're only a few tenths of a degree away from that at this point. And we're past, I think, according to this article, it said we're past the point of no return. So it's happening, unfortunately.
Yeah, there was also this storm in Mexico, like out of nowhere. It was not really predicted. Everybody was surprised. That's scary.
Yeah. Yep. It's very scary, especially for our kids.
Yeah, exactly. I think really things have to change, especially in the perspective of our kids, right? For the next generation.
Yeah, you'll find from an insurance perspective out here in California that a lot of people are suddenly finding that their insurance companies are canceling their policies.
Exactly.
Yeah, and they have nowhere to go. And without insurance, your bank, if you have a mortgage, which 99% of the people do in California, they will assign insurance to you, which can cost potentially something egregious. And that becomes another issue that rolls right in. Yeah, I think if you think about other sectors, if you think about healthcare specifically in the United States, the effect that insurance has had on individuals becoming doctors has changed the landscape of healthcare in the United States. I would say it was significantly better 30, 40 years ago before insurance premiums got completely out of control for doctors. It's now not attractive to become a doctor. It's difficult to make any money and the liability is so great. And at the end of the day, you just want to help people. But if there's all these burdens in the way of actually you doing anything positive, you're probably going to look for a different field for yourself. And that's what's happening, sadly.
Yeah, but that's also not in our sense because we want to have good doctors. So if you want to have good doctors, it must be interesting to become a doctor. And the whole healthcare system is kind of, sick.
But I would say here, going back to your point about insurance was really the catalyst that kind of sent our healthcare system towards the abyss. And it continues to get worse and worse.
Because for our healthcare system, it's really more of it's not insurance, it's really a payment system. It's a financing scheme. Anytime you introduce a massive financing scheme to an industry, it generally tends to inflate. It breaks down the pricing structure and just the normal market mechanism that would be in play.
Okay, so last time we spoke about the pack of fresh IPOs, right? It seems like it's been pretty eventful since then.
I don't think it was a full pack. I think the pack was missing several pieces.
There was a trifecta. How about that?
Yeah.
Not quite a gaggle or a coven.
There were like three.
Yeah.
There were three. Then we had Birkenstock since then as well. So it is a trickle of sorts.
We're getting to the end of the year. And so that also means that we see the final view key decisions from the central bank and the Fed. Also, we're in the middle of the Q3 earnings. Tomorrow will be Apple, the biggest company in the world. And on top of that, to add to the mix, we get some new geopolitical situation heating up. So how does that look from your end?
Yeah, it's exciting, isn't it?
Very exciting.
Very, very exciting. Yeah. Lots to talk about. Always a lot of news flow. But generally, as far as markets, I would say that a lot of the themes that we've been discussing for months, they're playing out, but they're just playing out in force. We've seen an interesting mix of macro factors in play. That includes moderating inflation. That's offset by a hotter growth picture, a more kind of higher for longer outlook on rates. On top of that, we have a yield rally, especially at the long end of the curve in the US, and now a general increased sensitivity to risk with this added element of geopolitical uncertainty coming out of the Middle East. And the IPOs that we discussed, those Klaviyo, ARM, and Instacart, they have had trouble breaking out in this context, and they're basically at or under issue price.
So that looks like the same for the whole market in general, right? So major indices are now back into correction territory. What do you think?
Yeah, just looking at the S&P, it's down just over 10% since the July highs, which kind of makes it a correction, if not an outright bear market. And generally, I would say that the tenor of the markets has changed since last summer. It seems like we're just generally more attuned and more conscious of unforeseen risks. And you can see this reflected in the VIX, which is bouncing around near the 20 level. I think it's at 18 today, but it closed at 22 last week. Gold is over $2,000. That's the first time since 2020 when it spiked. So these are classic risk proxies. It just shows you that the market is a lot more aware and sensitive of the unforeseen.
Yeah, and not even the big tech Magnificent Seven is holding the market up like it did all year. That's what basically helped, at least me, to be in the positive area with my portfolio. I just was lucky also because of your hints and your recommendations. I bought enough of these 7 magnificent companies.
Always happy to help, Fabian. But yeah, no, it has been a very top heavy rally for the year. And this is just the way that the markets are constructed and the way that these indices are constructed. And if I exclude the big tech, it looks a lot more disheartening and is essentially flat to down and potentially quite a bit down, depending on what market subcomponent you look at, right? And big tech is not providing the support that it once did. It basically gave up all the gains since May, but not the whole rally for the year. If you're into technicals, this is certainly a kind of an interesting technical formation and a pretty critical level, I think, for the group.
But it looks, some say that it's because of the earnings season. I don't know. What do you think?
I think the consensus takeaway is that it's been a mixed earnings season, some hits, some misses. Generally, this is happening in the context of just weaker market sentiment. Some of the exuberance that drove the market this year, a lot of that was AI related. That appears to be confronting reality and running out of steam. Like we talked about earlier, we know about AI, we know about we're just trying to kind of learn how this manifests in a commercial sense and in markets, and we're learning to basically live with the tech, but it's not really providing that same sort of boost to the market that it did earlier in the year. But as far as earnings, some big tech companies, they had a strong quarter, Netflix being one, others like Tesla, not quite to the same degree. I would say the most interesting set of reports were probably from Microsoft and Google. Google was the biggest decliner on earnings week, fell like 10%, despite having a top and bottom line beat. And I think part of this was related to Google Cloud. It grew pretty robustly at 22%. I think that was the number, but it missed estimates. And all of this is related to AI workloads, and it just shows you the importance of the perceived importance of running AI workloads for these cloud companies. And generally, I would say that Google has been perceived as a bit of a lagging operator in the AI space, eclipsed by Microsoft with the OpenAI collaboration. And you can see this somewhat reflected in Microsoft earnings. So Microsoft did beat pretty soundly, and it beat most critically in Azure. That exceeded consensus growth. It came in at 28%. It was, about 26% was the consensus expectation. And with a noticeable contribution from the AI workload, it was about 3% of the total. So now Azure is bigger than Google Cloud, and it's also growing at a faster clip. For others, Amazon was not quite as exciting. AWS, it's a bigger business than Google Cloud or Azure, but growth pretty much came in on consensus. In other developments, I would say that the ad revenue space there was some pretty interesting commentary there. Ad revenue appeared to grow pretty well in Q3. I mean, Google search and YouTube, they were both at 11 and 12% each. Meta was at like 28% on their ad business. Impressions were up like 30%. But during the earnings call, Meta also alluded to just some weakness that they're seeing in ad spending in early Q4, and so that kind of offset a bit of the optimism. So it's guidance and kind of forward outlook is as important as anything else.
So when you compare Google with Microsoft, Google did outperform Microsoft.
I can tell you from a more macro perspective, Microsoft has entered into partnerships with Open.ai and some other companies that have bolstered their position, while Google has effectively grown their own and done everything in-house. And who's to say what's going to end up being a better strategy, or perhaps both are great strategies. But over the past year, the most resilient space that we've seen has been artificial intelligence. And as things continue to come up and grow, and as partnerships continue to be made, the ones that are complementary and accretive to the ultimate goal of the organization are the ones that are winning. And I think that is the primary reason that Microsoft has done better, at least in this short window, than Google.
They've outsourced so much of this development to OpenAI, and OpenAI has been extremely aggressive about it. I think that speaks to the value of having a very focused, very large, very well-capitalized partner to run the strategy for you. And Google is doing this for the most part in-house, and Google is, doing the right things, right? I mean, they did right to get Bard integrated into search. I use it. I like it. I think it's useful.
In maps. No, in Europe, it's not available at the moment, but this full integration, we haven't even seen that here in Europe. It's integrated in like everything, into the documents, into maps, into the search itself, also pictures.
I think getting it integrated into search is probably the most important component from a branding perspective. ChatGPT was the first mover, and it became eponymous for generative AI in general. That's how people refer to generative AI. It's either chatbot or ChatGPT. So they definitely have that first mover branding advantage, but getting the Google product in front of search users, that could dilute that brand lead at the very least. And, Google, I would generally agree with you. They've been a thought leader in the space for a very long time. And so over the long term, we'll see. It's which strategy will ultimately win out.
Yeah, when it's worth a certain amount of money, you're going to start to see rumblings of antitrust issues and other similar, as Max mentioned, more political agendas arising. And the spoils go to the victors every time. So
I think there will be a lot of money around this AI topic, around Google AI and Open AI and Tesla AI. I think that these three companies are the leader of the pack.
Yeah, which also, to bring the private markets into this, a lot of people are trying to figure out which player is going to be the new up and coming superstar. And in this world, at this time, you can pretty much bet on the big guys. Why bet on the little guys when you can bet on Google and Tesla and Microsoft?
OpenAI is basically still pretty small.
Yeah, but how they're structurally set up as a Max? Is it a nonprofit or a charity, or how does that work? And will they ever go public? So who do you invest in?
It's a really exotic structure.
If you want to benefit from Open.ai, you have to invest in Microsoft.
Yeah, let's see.
Yeah. It's not a game for the lean little startup. I think we've seen a whole slew of startups that are essentially kind of wrappers for these large language models and access them through APIs. That's an artifact of this little localized AI bubble cropping up. I don't know if those companies have a longer term perspective. It might just be that OpenAI is basically incubating an entire industry and then putting them out of business and then absorbing them. That is happening to AI startups already, right? So any new feature that OpenAI releases, it tends to kill a certain subsegment of those little wrapper startups that
even they like out of their own ecosystem.
yeah.
They basically disrupt their own partner companies.
They do, because there's probably more of a commercial interest in getting these companies working on their specific little area of innovation, of actually deploying these technologies, and then basically absorbing them, learning best practices, essentially copying the best when they eventually consolidate away, which which they are, right?
But we've seen this historically. Use Cisco as a case study. They have acquired many companies over the years only to shut them down, because they were competitive with something that they had in-house that they wanted to grow. And I see history repeating itself with AI for sure.
It's also cultivating talent, right? So you have more people working on this problem and learning how to actually commercialize the problem. So you're just seeding the human capital picture with specialists, and there are just not enough dedicated AI specialists to work this whole theme, right? To bring it to full fruition. So that may be just a means of doing that. So yeah, and they're doing it with other people's money, which is always smart.
Yeah. Things shift very quickly at the moment, and the whole space is moving very fast. It's really, as you have said, Tim, you rather go with the very big companies instead of gambling with the small startups.
Yeah, I would say that you can be a successful company and essentially be a wrapper for another core service. So Klaviyo, which went public recently, they very heavily rely on the Twilio API for their messaging, but they add a whole suite of value-added tools and services on top of that, right? So you have to focus on your value add as a company. If at the core essentially doing these API, you're providing API access. There has to be enough kind of inherent merit to your platform, how you deliver the service, for you to be a standalone company doing that. It's possible, but it's difficult, right? It can't just be
Absolutely.
a small incremental improvement. Sure, and
Well,
conceivably, even if you take OpenAI, they would be completely dependent on Azure. There are these critical dependencies with even very large companies, but it just so happens for Klaviyo, they're dependent on the Twilio API on the back end, and they're dependent on Shopify as a go-to-market channel on the front end. But I think that goes to some degree for most companies.
And I think it's interesting to note Klaviyo is one of the recent IPOs that we've talked about. They went public almost a month and a half ago, and they're down over 18%. I think they're trading at $27.50 today. And unfortunately, I'll have to look back on the historical pricing in the private market, but some of these companies, it doesn't make sense to buy right now. And I think if we want to shift gears to the private market, we're seeing what we thought was a resurgence of bidders coming back into the market and the spread tightening, to more recently seeing some of the numbers in the public markets. We're seeing the bids drop off again and spreads widen, and buyers looking for more fundamental based opportunities. High flyers that don't make sense, people aren't as interested in. We're seeing a massive amount of supply in some of the bigger names, and just almost no demand. And there's a clear reason in my mind why that's the case. And it's because at these levels, fundamentally, they don't make sense. And investors realize that there may not be a light that's that bright at the end of the tunnel at this point, but it's still pretty dim. It still may take a while. And those companies are probably going to fall, maybe some fairly significantly, before they rebound. You look at a lot of the tech companies in the private markets, the unprofitable tech companies, and they're down 50 to 90%. Again, some of the high flyers haven't taken that hit, And I will say yet, but my guess is they will. No one's immune to something to a nuclear winter that goes on for more than a couple of years. I think this is a great segue, Fabian, for something that Max and I discussed yesterday. And Max, I'd appreciate if you go into it in terms of how companies are essentially finding ways to spend less money, tighten up their operations, and create efficiencies across the board. And that's what has to happen in times like this. Please expand, Max.
Yeah, this is a bit of a tangent, but it's relevant, and we've talked about this in prior episodes. But companies, the growth at any cost has consequences, right? It teaches you to operate your company in a certain way and to very quickly change gears to actually generate profitability, or at least get on track to do that. It's just not what a lot of these companies have been accustomed to, right? So they have to both lean out their operations, and they also have to experiment with new pricing structures, with kind of focusing on their value add. I would say it's been a systemic issue in especially the VC backed ecosystem, that companies have essentially underpriced their product. And gradually you're probably going to see revisions to that, but it is going to be accompanied by missteps. It is going to be painful for some companies. There are going to be some users that are alienated, but that's just the reality of it. It's just the market environment that we're in.
Yeah, so that's why there is a lot of discussion about, will there be a crash? Will there be a hard landing or not? So let's continue with the slides, Max. Okay, Tim, want to continue? Yeah, so we are basically going back now to the market in general, market generally, and basically it still looks it's going okay. Max.
So far, we're recording this on the 1st of November. I guess earnings season has been focused. We're not done with it quite yet, but based on the numbers that we've seen, we've managed to avoid our earnings recession, right? We've had 2 pretty weak quarters, but we're actually seeing companies on the whole post a solid quarter, at least superficially. Slide in particular, this is as of last week, but it reflects almost 40% of the S&P reporting, and I think 60% of the market cap, because the larger companies, they tend to report earlier in the season. But I think it's I think it's interesting. There's obviously a mix across sectors, as you can see, but there's generally pretty strong year-on-year growth in EPS. This overall number might get smaller as the smaller index constituents report, but it's a solid showing. Clearly concentrated in communication services. That's the standout. That has some of the bigger tech companies in there. Those are the large EPS drivers. The other thing that you should note is that revenue is not beating at nearly the same rate or increasing at nearly the same pace. So this tells you that there's a whole lot of margin optimization going on. And again, the outlier print and communication services, that is directly related to these very large companies like Meta and whatever, basically optimizing their operations and laying off quite a lot of their headcount. And so their expense structure it's certainly different than it was a few years ago.
But yet, it's not enough to regain positive market momentum to the upside for now.
Yeah, guidance is certainly an issue. Anecdotally, just looking at this earnings season, guidance, generally speaking, is overshadowed by concerns, uncertainties, and you just see more and more allusions to that crop up. The rate of companies revising their guidance higher is also well under average. So it seems like we've just realized a lot of that growth just in this quarter. And then this has been the case for the last few quarters, where companies have tried to moderate their guidance as best as they can, but it is certainly well under average, the rate that companies are actually trying to step up their guidance. And there's just generally a propensity for this market to react more strongly to downside catalysts than the upside, and at least that's the case at the moment.
But the overall economy, it's getting a little bit boring, I think, because still everybody's talking about this, all the factors, inflation, yields, and the like.
I don't know if we're walking in circles. I think there's one thing that's important to note. If you take a much broader perspective, you zoom out to 30,000 feet, 100,000 feet, what's happening to companies right now is they're evolving into much more resilient models. And for the future, that's going to be meaningful. What happened when money was free and we were on this bull market from, call it 2009 to 2021, a lot of inefficiencies crept into these companies, and those inefficiencies are now being eliminated. A lot of the constraints that were created because, as you talk about growth at any expense and that kind of thing, people are rethinking, and all of those changes that are being made are ultimately positive for the entire ecosystem for our country, for sure.
Okay. You want to say also something to this point, Max? Or want to go to the next question?
I've got this whole response here, right? Yeah.
You want to bring it?
I do.
You want to bring it?
I do want to bring it. I did in fact write it, so I was intending to say it. Yeah, I would say that long term for companies learning how to operate in general, as far as market performance today and what drives markets, what kind of keeps markets down, or which has been the case recently since July, it's a lot of these kind of broad macro factors. They're still major drivers, but their interplay has been evolving, right? First of all, we just to address the Fed, right? Fed and inflation has been a major factor. Stated very simply, if you just look superficially at the lagged hard data, inflation has been cooling gradually. Some subcomponents have been more volatile, some have been kind of leveling out, but it's been, generally speaking, it's been moderating. So we're no longer really getting the major surprises from the Fed decisions themselves, and they're pretty much staying on script. And we have a Fed decision today. The consensus,
actually, in a few minutes, Max.
Yeah, universally, there's not expected to be a hike. There's not really expected to be any material modification to the ancillary language that they use. And there's still a low likelihood of another hike this year. And then, as far as anyone's concerned, we're basically done. If there's not a hike this year, July was the last rate hike, which coincides with the peak of the market. There's an old kind of market truism that you sell the last rate hike, and I guess the flip side of that is that you buy the last kind of rate cut, right? But we're very far away from that starting to cut. It could be as late as Q3. On average, it's about an 8-month lag between the last rate hike and the first rate cut. Although it can be shorter, it can be longer. But the Fed decisions themselves have not been that surprising, but Fed outlook and yields still have a major impact. We saw this in September when the Fed released their summer economic projections and their dot plot. That certainly impacted the market. The story there was, I think we've talked about this, is their outlook for 24 and 25 rates. They reflect higher growth, but also higher rates, and Fed funds over 5% for basically the entirety of 24. So that was quite a bit of a kind of a hawkish upgrade for the market. Their guidance still has an outsized impact, but so do the yield markets, and there's certainly a story to be told there as well.
So the 10-year getting to 5% seems like an important level, and yeah, me too. So as so many people, we all bought TLT much too early.
Yeah, it's certainly been a very strong, very rapid yield rally. And I think it's important to note that this is happening in the context of lower inflation, just based on the numbers. So real yields are significantly higher than they were. And generally, when we talk about yields impacting stocks, it's really the real inflation adjusted yield that's important, right? It has a significant correlation to stock levels and valuations, as we can see here. And stock indices, if not actually individual stocks, have managed to levitate above these rising real yields all year. And again, you could argue that this is the AI theme, this is the tech rally in play. But as these real yields blew out more, this force of gravity is starting to really reassert itself. There could be more downside there for stocks just based on this historical correlation. And it's not just the 10-year. It's
Hey Max,
also,
they didn't move it,
which is no surprise. That's exactly where where consensus was, and it does make sense. But yeah, it's not just the 10-year that had this effect, right? The yield curve in the US, it inverted in the summer of 22 and became very inverted since then. And this is possibly reflective of the belief that the Fed would reverse course on rates in the immediate future. That did not happen. That was the Fed basically talked that whole narrative down, or at least did work very hard to talk that whole narrative down. But now this whole yield curve is steepening out in what is called a bear steepener dynamic, with long maturities basically catching up and soon potentially exceeding the short end of the curve. And there are probably multiple technical and fundamental factors why long bonds are selling off like this. But I would argue that the fiscal picture is really the large culprit, or at least recently. And again, we've talked about this before, but US deficits are staggering, and they came in over consensus. It was $1.7 billion deficit as of the fiscal year end in September. That's 23% year-on-year growth, $33 trillion of total debt. The higher interest service costs on these kinds of balances are becoming a real concern, right? So overall, the picture is much more bond issuance, almost $800 billion of fresh bond issuance by the end of this year, something just like over 800 billion for Q1. That's done a lot of the Fed's work for it. Anticipation of this level of bond issuance, I think it certainly was a very material factor in driving the yield rally across the curve. So the Fed, in some sense, doesn't really have the need to surprise markets anymore to tighten up financial conditions. And actually, we got a report today from the Treasury. It's their quarterly funding outlook and their auction outlook. And that came in a little bit under where the market thought it would be. So a little bit less bond issuance volume across the key maturities. Very small difference, but it certainly was not over. And I think that impacted the kind of the bond markets today a little bit. But this is an important space to watch. We're getting to those kinds of levels in the overall fiscal construct of the United States, that it's becoming a market concern. And we've obviously known for years, it's always been a known quantity that the US runs a gigantic debt load and can't really pay it off. It's an integral to the structure of the system. It's part of money supply. But with rates at these levels, it's certainly becoming more relevant.
And despite all this, we are not really seeing this crush economic growth data either. So basically, when the TLT is a bet that you have a hard landing, you have a recession, and rates go down.
Yep. So you have a bond rally and you have yields go down.
Exactly. But at the moment, you don't see that this economic growth data is under pressure.
Yeah, not yet. And I think that's been surprising to a lot of market watchers and participants. We're not really seeing the hard data, as lagged as it is, and with all the construction that goes into it, we're not seeing a precipitous economic collapse reflected in data. This recent Q3 GDP report that we got in the US is really case in point. So we got on the surface, it's a pretty strong report, 4.9%. Annualized real GDP is a major beat versus consensus. I think it was like 4.2% consensus. And as you can see here, it's more than double the Q2 print. Also important to note, the US consumer has been surprisingly resilient. Despite,
the consumer, that's also something I have to remind me all the time. Namely, please correct me, like GDP is driven in the United States, 70% of GDP is driven via consumers.
Consumer, yep. Consumers.
That's tremendously, yeah? If you have under control the consumers, you have under control the economy, simply spoken.
Yep. I mean, it's 70% is consumer, and a large part of that is services. The consumer piece is critically important. We really saw the consumer piece really reassert itself in Q3 versus Q2. Personal consumption in the face of higher inflation, in the face of higher rates, which impact your credit card APRs, it's been very surprisingly resilient. As you can see here, it was the biggest contributor to the reading. We also got a major contribution from inventory buildup and clearly direct government spending, which is not surprising given the deficits that we're running. But in the context of this kind of data, it's really hard to make the argument that the Fed will cut rates meaningfully in the very near term, right? Unless something breaks, we're in a higher for longer environment, which echoes the September SEPs and the dot plot. And if this is the case, then the curve continues to bear steepen, and the longer end of the curve could keep rising, and that keeps putting pressure on financial conditions and liquidity in stocks, and probably leads to a stronger dollar, which again is a detractor from earnings and from liquidity. It's certainly a factor to watch.
I'm just looking at that chart for the first time, Max, and it is a really strange chart. Would you admit?
It's really strange.
The GDP chart that was just up, Fabian.
Yeah.
Maybe go back to it.
I mean, if you look at,
here we go.
If you look at the personal consumption expenditure,
so yellow.
During COVID, it went bananas, and then in the first quarter of 22, it was zero. How does that make any sense? And then you look at the change in private inventories. That one is questionable. The government consumption expenditures and gross investment, I don't. First of all, why does it flip flop from? I guess it's because it's negative and positive. But yeah, that one is strange to me as well.
Where do you have this from, Max? I can't see the source of this slide.
Yeah, I think this might be directly from the BEA,
which is
the Bureau of Economic Analysis.
Let's ask them.
Let's give them a call.
Yeah, I'd love to know where these inputs came from.
But it's important to note that these are growth contributors, right? So this is percentage growth, annualized quarterly growth. It just so happened that in June of 22, according to the calculation, personal consumption, it was a detractor, right? But by that amount, just green annualized. And you can see they're fairly volatile, right? So they can mean revert and they can bounce around. Over time, you can get the general sense of the trends involved. The inventories, they tend to be quite volatile. They tend to flip from period to period, which makes sense. You build up your inventories and then you sell them, and that becomes consumption. So if you build up inventories in one quarter, you sell them in another. It's not necessarily a subcomponent that you would expect to just grow in a linear.
Yeah, I don't know. I remember everybody coming out of COVID when they began to travel and go out to dinner and do everything. It seemed like personal consumption expenditures were going up, but according to that chart, they were going down.
Yeah, we had those two weird quarters in 22 when we were in that quasi recession, right? When we got those negative GDP prints. So that may have been the recession, for all we know.
A quick one.
Yeah, a very quick one. Not even a technical one. No one admitted.
Not a technical.
Well, talking about recession. So the famous claim by Max, as long as nothing breaks.
As long as nothing breaks, right?
As long as nothing breaks, interest rates keep going high.
Yeah. Eventually, you're going to need to get to a normal yield curve, and if you keep short end rates where they are over 5%, then just based on term premium alone, your 30-year rates are going to be quite a bit above that, right? And this impacts a whole lot of stuff. This impacts obviously mortgages. This impacts the cost of credit for companies. So it is important, right? But it could break also, right? There could be just a general flight to safety. So there certainly is some upside risk in bonds, right? And I think this was last week when Bill Ackman came out and tweeted that they closed out their bond short, which caused a bit of a bond rally.
Who is Bill Ackman? I've heard this several times this week. Who is this guy? It must be like a heavyweight at Wall Street, but
yeah, he's just a major hedge funder, Pershing Square.
Yeah, but these hedge fund guys, they're also famous just for doing some bets and then talking about these bets, like these contrarian bets, and then they talk like all over about this part of the game.
Yeah, Ackman he's cultivated a public profile, and it's the ancient, time-honored art of talking your own book and swinging markets in your favor.
Will there be a self-fulfilling prophecy? Because he's not the only one.
No, and I think he makes a valid point, right? So his argument was that there's way too much potential risk in the world to be short bonds at this level. There's just the risk reward. They look at things from a risk reward perspective, and that risk reward just might not make sense for him. When I talk about the yield curve bear steepening beyond this point or rates rising, right? It's all else being equal. And it's rarely that kind of scenario in the real world, right? But as far as GDP, again, I think this is another thing that Ackman alluded to is beyond kind of the unforeseen risks, growth, according to him, is weaker, is reflected in the numbers. So just looking at the numbers, it's unlikely that we'll get another GDP print like we did in Q3. I think this was a standout quarter. If you just break down into the subcomponents, inventories, as I said, they can mean revert. Government deficit spending, depending on who's in charge, they can get cut, right? And the consumer, that consumer piece of it is incredibly important. So if you could just go back to that chart.
Can you see it?
Yeah,
Loading.
yeah. So this is a fairly concerning chart. So as part of the GDP report, we also get a look at personal savings. And this is concerning, right? So we obviously saw personal savings spike with COVID stimulus, the several rounds of COVID stimulus. You can just you can see that right there. But we
But you can see right there how stupid that was. That was really a bad idea, wasn't it?
Well, I mean, and we're still that was one of the major drivers of inflation. You shut down the real economy and you just try to paper it over with free money for everybody. But we've blown through that, right? So we've had this excess savings spike, which is above the long-term trend line, and we're under it now. If we were at trend, long-term savings would be just under 2 trillion, right? And we're nowhere near that at this point. We're at under 800 billion, right? So there has to be a limit to how much the consumer can stretch, and we might find out soon enough. So I would watch this space. I would watch other data that relates closely to the service economy, specifically like the ISM services report. So we'll see. The consumer being the bigger or the biggest part of GDP is now running on fumes as far as their ability to consume. And once you hit some kind of a natural bottom there, you'll try to extend this out through revolving credit, whatever the case, right? But there's a limit to that as well, especially at these kinds of rates.
Hey, Max, are there any non-US catalysts that you can think about that could cause our situation to, as you say, break? Things like Ukraine or Israel or Japan? Obviously, there's some pretty dire situations around the world right now.
Yeah, how about all of those?
Okay.
But it's also, but look, it's also a fact that this is not brand new, this situation. It's escalated. It escalated on a level that was, for years, it was very tense. So it basically, as we can also see in the market, they're not really surprised.
No, and the Israel and the Middle East situation, you can see that like the VIX spiked, right? Gold spiked. So there is a little bit of a kind of an unsettling nature to it, but overall that was not a major driver of the markets. It wasn't even a major driver of the oil markets, right? There wasn't a crisis bid for oil. So I think so far it's still being perceived as a really localized conflict without much strategic spillover into the region. And clearly it entangles a lot of the very important players there. It entangles Saudi Arabia and in Egypt and Iran. But so far, they're not directly participating. So far, we're just dealing with the Gaza situation, and that has more of a humanitarian nature to it than a strategic one.
This is absolutely horrible. There are some carriers in the Mediterranean Sea, and they just signal, do not join this conflict. And it ends up that Hamas made a huge strategic mistake, because now it looks like Israel really is cleaning up the whole Hamas situation in the Gaza Strip.
Yeah, Israel's pissed, and rightfully so. It was the attack was an atrocity. Clearly, cleaning up Gaza is also going to be extremely difficult and painful for everyone involved. But I think the larger players that are entangled into the situation, I think they're being pretty careful about it, and for good reason. The carriers there, U.S. involvement there, as far as I can tell, primarily has to do with hostages, with U.S. hostages. If we send out rescue missions to get hostages, which we may, it's a mobile base of operations, but probably not trying to project our power into the region. I don't think the situation strategically warrants it at this point.
When you park your carrier in front of the coast, that's a huge signal.
It is a signal. Again, you need a fairly, I would say you'd need a more elaborate base of operations than a sub. The thing about the hostages is that we don't know where they are.
Mm-hmm.
And they're stuck somewhere in Gaza, which is the size of a major city. And so getting intelligence assets mobilized, getting kind of special forces mobilized, and getting all of that into place is more.
Everything happens in middle of the civilians, families, kids, and they don't really know where to go. So it's a huge mess. It is
a huge mess. But again, the tension there it's a known quantity. It just came to a fore. The timing of it is interesting. I think in the geopolitical community, I think the consensus was that if Iran was involved as a sponsor of this operation, they really considered timing in the context of Saudi-Israeli normalization talks, which were ongoing. So there was an effort to derail those. And that may have worked, right? So those talks are, as far as I know, are paused. And Saudi is starting to build really preliminary diplomatic bridges with Iran, and this was
towards west.
Potentially, Iran is it's interesting animal, both politically and where they align strategically. I think
the mullahs they do not represent Iran people. They do not really represent the Iran people.
No, and clearly we've seen rumblings and little attempts at some kind of revolution, but they still have a pretty strong hold on the power structure over there. I think there was this idea that Iran was aligning more closely with Russia in the context of Ukraine, but I don't think that's a very durable partnership long term. It really isn't. I don't think there's really a very strong affiliation. I think it's a marriage of convenience between Iran and Russia. And they're seeing Russia. I don't think Russia is a very reliable partner for their strategic interest, and they have strategic interest in the Caucasus. So they have strategic interest in kind of keeping Azerbaijan in check, and Russia just can't do that anymore. Russia is not the security guarantor to the region that's directly to the north of Iran, because all of their military assets are basically dedicated to Ukraine. And so if Russia can't do that, what's the point? Right? So you might try to find other partners elsewhere. But it's complicated, right? What Iran certainly doesn't want to see, I think historically, is an alliance between Saudi and Israel, because that would obviously be the dominant power structure in the region.
And Saudis don't want to have trouble at the moment. They don't want to have trouble down there.
They don't, and I think the new generation, bin Salman, the younger ruling group, they're more progressive in how they manage their foreign relations, I would say. So I think that progressive might not be the right word, but they're more pragmatic, right? So I think they're more willing to create those bridges with Israel, because
I think progressive. That's the right word. I also think
progressive and pragmatic, right? Less kind of dogmatic, right? As contrast.
All the investments they do into the soccer, building bridges. They also want to have fun. Makes sense. I mean,
yeah, maybe Saudi Arabia is the Switzerland of the Middle East.
Yeah, I don't know. I don't know.
Yeah, there are a lot of just strategic synergies between them and Israel, so it makes sense for them to cooperate. But this kind of alliance excludes Iran to a great degree.
Yeah.
So
let's see.
I'm sure they're not happy about that.
Hey, Tim, you want to say something about this Bloomberg article?
No, I wanted to actually have Max read it, but I don't think he has. It's really an argument for continuing to raise rates, and effectively it tries to state that a more aggressive tact could potentially be a really good thing for our economy in the long term. If we do not raise rates in the interim and in the near term, this thing may continue to overheat. But Max, I'd love for you to read the article and fold it into your narrative, because I think the author makes some pretty good points.
Let's talk about that next time.
Yeah.
Didn't see that yet. If the bond market keeps doing its thing, there's just no need to raise rates. So for all the key maturities that kind of are that impact the very large parts of our economy, the yields could keep rallying.
So last but not least, what do you recommend? If you are invested into TLT, keep it or sell it or buy more?
I mean, that's a great question. I think you should take a look at the chart of the Fed funds rate and the 10-year and how they interrelate. So if you just take them as an average, the 10-year on average over a long-term average is something like 100, 150 basis points above Fed funds, but not at the peak of the Fed hiking cycle, right? So if you look at the Fed funds chart, it resembles a little step up to a plateau.
Is it number 5 here? Is it this one?
No, I don't have it in the slideshow, but
We had the comparison between S&P and
that's S&P PEs and the real 10-year. But if you just Google the 10-year versus versus Fed funds, when we hit that plateau of the Fed funds rate, then historically you could see Fed funds exceed the 10-year. But the 10-year will probably, if you just look at history, will probably be sticky once the Fed starts to cut rates, right? So therein you get the average relationship of the 10-year, generally speaking, being more expensive. I would say that for 24, all else being equal, you're probably looking at the 10-year on par with Fed funds. And again, different maturities have their own different dynamics. But if, depending on where it is today, it could be, where are we? We're at 8.448. I think it came down a little bit, but it could bounce around in that low 5% range, unless there's a massive flight to safety for a variety of reasons.
We don't see yet.
We don't see yet. It's an interesting relationship between Fed funds and longer maturities. That's a chart that I would encourage you to Google.
So today went up 1.5. So TLT is 84.5. That's right.
Yeah, I don't track the TLT as much as I just look at the yield itself.
Okay. Well, guys, that was a long one.
Yeah.
But that went deep. It really helps to assess the current situation. And we keep
for a
going.
market update.
Yeah, exactly. That's why we're doing this. So thank you very much.
Hey,
thank you, Fabian.
Thank you. Yeah.
So, yeah, that's it for today. Please click subscribe and we see you next week. Bye.
Ciao.
Now it's
That's
better.
good. Yeah.
That's as high as that goes. And my screen that's on my arm.
Now, if you sat on a dictionary right there, you'd be perfect.
Have to find a dictionary.